Okay, welcome to JasonInvesting.com episode 1. This show where we deep dive into the world of finance and investment to help you make smarter decisions with your money. I'm Ken, your host, and today we have Jason and Andre from Jason Investing. Jason is a certified financial analyst with a wealth of knowledge on building investment portfolio for long-term gains. Today, he'll be sharing his insight on how working professionals like myself can effectively plan and invest for the future. So let's get started. So, Jason, welcome to the show. It's really great to have you here. So, to kick things off, could you tell us a little bit about yourself and what made you interested in starting JasonInvesting.com?
Hi, Ken. Glad to be here. So, I've always been interested in teaching and sharing knowledge, and I feel that a lot of people they have interest in investing, but they are always kind of like doing it the wrong way. And yeah, I mean the simple answer is just sharing what I know, and basically to just to give the opportunity to give myself the opportunity to also teach people. It's always a dream of mine.
So, JasonInvesting.com is like an education platform, right? It is a newsletter for people to learn how you invest, right? Is that why you
Not strictly. I mean, but that's part of the motivation for the newsletter. But also is to give you updates on the market, and also to give you actual trade notification that you can actually act on data, but with a lot of caveat that is that basically there are risks that are involved, and we for our newsletter we take the simple assumption that you meet a certain profile, and if you do, basically, if you act on our trade notification, and you're comfortable with the risk that is involved, you can. I mean, we will advise that we probably start with a paper account and play around with it first before, and feel comfortable, and also ideally, you also need to be kind of aware of what kind of trades that you're making, because we involve options that could be they could be very risky. So you need to be prudent on that as well. But for any trade that we make, we will always give a reason, and also that it's that we hedge in a sense that you will not, if the options are like not naked, so you will not have like unlimited loss. But basically, we can give an upfront calculation of what is the maximum loss and profit for the options. Yeah.
that's great. Yeah, I'm actually very excited when I heard you are starting this newsletter. Um, just a little bit of background about myself. I've been a working professional all my life. So for the past 16 years, I was into investing, right? So I personally invested in stocks, and I invested in a little bit of a mutual fund, right? But then every time I just found myself having this excitement right at the beginning, and then as the economy gets worse, I start to lose money, right? So when that happens, it really hurts me emotionally, right? Because I've been saving all this money all my life, and then suddenly this happened, right? So when I start to lose money, I lose the motivation, right? And then so for the past 10 years, I really haven't really picked up myself, right? So when I really heard that you started this newsletter to help people to have the right knowledge to invest without but by minimizing the risk, I'm super happy about, right? So currently I mainly invest in stocks, right? And then I don't have a strategy of I should do, right? But because of my past situation, I actually don't want to I kind of not want to get back into the stock game, but I want a safer way to invest, right? So what do you suggest? I heard people are investing in the indexes and stuff like that, right? But I have no idea. Like, what do you suggest I should do?
Yeah, actually, before that, do you want to introduce our Andre as well, because he is also in the call?
Yeah,
Yeah,
yes. Andre is our other host. Andre,
yeah,
you want
yeah,
to tell us
yeah,
something?
Yes,
yeah. I
Andre, do you
mean,
want to say something?
yeah,
Introduce yourself.
I'm very new to S&P 500. In fact, I was quite skeptical to what 500 S&P 500 is about, because for me, I'm also a working professional, and for me, I have also future plans to save up money for investment property, for example. And like, how would S&P be uh in terms of risk, and in terms of what could be the potential benefits, compared to, like, if I have my money to save, put aside and save towards a property deposit.
Okay, so basically, both you and Kenneth have the same kind of issue, right? Basically, you want to invest, but you don't know what to invest in. For Kenneth, he was talking about the stocks, right? Which stocks to buy, and you have to choose the stocks. But for Jason investing, what we focus on is uh, our main strategy is dollar cost averaging into the S&P 500 index. So we do not stock pick. We do not pick any stocks. We just invest in the S&P 500. And so Andre was saying that he's kind of like uh, reading up about S&P 500, what exactly it is. So basically, I mean, if you know about the efficiency market hypothesis, it's basically you cannot beat the market, right? For most people, you cannot beat the market. So rather than trying to beat the market, you would just invest in the whole market. And the reason why we choose S&P 500 is because the US, I mean, in terms of market capitalization, right? The US is like the biggest stock market in the world.
Mm.
And because in the US, and S&P 500 is like the 500 biggest companies in the US. So basically, they're large cap blue chip stocks. So they
Oh.
are not like small cap stocks, which are like kind of risky. So you need to meet certain criteria in order to be listed in the US stock market, right? And out of all those companies that are listed in the US stock market, they have certain criteria that takes the kind of like the 500 largest company in terms of market capitalization.
Mm.
So what does market cap actually means? So market cap, it just means that how the market value the company. So basically, it's the value is a share price multiplied by the number of shares outstanding, right? So basically, okay, so for example, Apple is $1 trillion market cap company, right? So basically, the market value Apple at $1 trillion. So basically, if the market value your company as a very high valuation, that means you are relatively safe. So this is means of when I say large cap, it
Mm.
actually means you are like a big stable company, right? And then because you band 500 companies together, so you have the diversification, and a lot of the S&P 500 companies are multinational companies, right? So basically, they do business across the whole world. So you have you're diversified in terms of geography as well. So in terms of like currency or whatever,
Mm.
you actually don't even need to worry about that because, for example, Apple sells iPhones in China, in RMB, right, the Chinese yuan. So basically, all this currency, whatever, all this will also be diversified. So S&P 500 is just a very simple way for you to invest in the broad market that cover pretty much the whole world. Okay, that's
Okay.
one thing, right?
Okay. So
Yeah,
basically, it consists of the top 500 best businesses in
yeah. Okay, and you see,
in the US market, not really in the world. So which
no,
means
but the US is pretty much the world. If you're talking about market capitalization, I don't really know the percentage, but it's pretty much the whole world. I mean, even some Chinese stocks are listed in the US market as well, right? So So okay, and just now you were saying the best, right? Like how do we know it is the best, right?
Yeah, so for me, but the best would be something that is affecting the performance of my S&P 500 performance. So what I'm saying is this
Yeah, but I'm
500
trying to explain.
will always be quite fluid in terms of if one doesn't perform, two doesn't perform, they just get off the 500 and
Yeah, I
and
think
another better one comes in to fill in the gaps, right?
they will periodically they will review. But what I want to focus on to say mainly is how do you define best in terms of market, right? They use valuation to define for you. So basically, if you have a high valuation, the whole market automatically vote you as you are the best, right? If the market cap for Apple or Tesla goes up, it's just the market saying that you are the best. You climb up in terms of the ranking, right? Because I'm actually using money to vote for you, right? I'm buying your shares. That means I'm voting for you. So basically, uh, in terms of market valuation, is the best way to access in terms of best, like in terms of whether you are like in the top or not. Anyway, okay, and the reason, another reason for choosing S&P 500 is because of the liquidity. So, for example, you might have some part in the world that you might be interested in investing, but if it's not liquid, right, there is it's not it's hard for you to invest in them. So the good thing about S&P 500 is liquid, and there are options on like derivatives on the index that is also liquid. So yeah, so it's just based on these two reasons. S&P 500 is a like you are better off for most people to just invest in the index.
Okay, so let's say obviously I have a savings goal towards something. In terms of S&P 500, uh, is it more advisable to invest it as a long-term kind of investment, or could it also do better in terms of short-term, say 2 years, 1 year, and then I liquid the
Okay,
amount?
so we do not support market timing. So for Jason investing, advocate long term investing. So basically, you are gonna invest money for the long term as long as possible. And ideally, it's probably 5 years or more, because probably that's the average time where you have like the market cycle, and the boom and bust cycle. So you don't want to have to sell when the market is at the bottom, and if you were like kind of like unlucky to buy at the top, so you want to you want to ride the boom and bust. But anyway, for our the target audience are those working people that want to put aside a part of their salary and dollar cost average in the market. And basically they don't time the market. They just keep on putting in the money, like pretty much like how you pay your mortgage, right? You always pay your mortgage for the house. So basically you do the same way for the S&P 500. And then we add some options trading for leverage or for hedging, to basically to increase your return as well.
Okay, so obviously there are a lot of people in the public who, before even knowing S&P 500, the traditional or rather conventional way is to kind of speculate a certain business and then try to make a guesswork on, oh, okay, this business, yeah, for example, is a startup, or this business, the share price is very low, but I have a confidence in it. I I buy it when it's cheap, but I have the trust in it. Or if the business is already good, like for example Google, Apple, this kind of business, by the time they are already proven to be good. The price is already so expensive to buy anyway. So would S&P 500 be a better way uh, to invest rather to go into individual business and try to, you know, trade in a certain conventional way?
Uh, okay, so Ken, do you have this issue as well in terms of like uh, picking individual stocks, and you're wondering whether uh, buying the index is less money making? Yeah, you want to say
Yes, yes,
something?
I do. So that's the problem with me for the last 10, 15 years, right? So I've been buying stocks rather than I'm buying into the indexes because it's too slow for me, right? I have an impression I'm just wasting time, right? But then that also caused me to lose a lot of the money because I keep on buying the wrong stock, right? I keep on speculating, right? So part of the reason why I'm so excited right now is because you are going over investing the into the indexes, right? It sounds like from this conversation, um, we are talking about, okay, should we invest into stocks? Should we invest into properties, right? It sounds like we're leading to the direction that we should be investing into S&P with dollar cost average instead, right? Is that where we are leading?
Uh, okay, so in terms of investing, just to answer on Andre's question as well. In terms of investing S&P 500, is relatively safer, right? Because most people cannot beat the market anyway. Like, what makes you think that you can pick a certain company or certain business successfully, right? So, so for most people, it's easier to just invest in the index. But of course, if you say you start your own business, and even though the odds are against you, but if it does succeed with a very tiny probability, you'll make a lot of money, right? So the idea, there's always a trade-off. So in general, it's more applicable for most people to just invest in an index if you don't want to spend so much time, or you will probably you're not going to beat those Wall Street analysts that have so much more money to research on companies and stuff like that, right? So basically, the efficient market hypothesis basically says that all information that we already know are already averaged into the market price. So basically, the market price is already the best average estimate of the value of the company. So however much research you do, probably will not really make much of a difference. I mean, some people they do beat the market, but that could be just by luck, right? But anyway, but if you just invest in the index, that'll be a very simple thing, right? Probably the Jason investing would not be probably be that much interesting or useful if I just tell you to dollar cost average into the index. We can make it a little bit more interesting by incorporating options into it. But the problem is most people do not know options, or they know a little bit of options, and they tend to trade it in a very very risky way, and you will lose money, right? Okay, there's no investment that would guarantee you to make money without any risk.
Mm.
So you can do that by buying T bills like treasury bonds, basically government debt. Those are the risk-free debts. Those are uh, in the past it was like close to zero interest, but now the Fed has increased the interest rate. You still have a relatively higher interest. Other than that, everything is you are being compensated for taking the risk. So, for example, S&P 500, right? It's considered actually very, very risky for S&P 500, but it's less risky than you buy an individual stocks. For example, I think recently Tesla dropped a lot in terms of the market price, right?
Mm.
Like if you buy an individual stocks, uh, it's a lot riskier because the volatility is a lot higher. But even for S&P 500, the volatility is also very high. Like during the '08 financial crisis, I think it went down close to 50%. So half of the value was gone.
Because it affects not only just one company, it may affect the entire 500.
Yeah, because it's a systemic risk that the whole market drop, and when there's a financial crisis, everything drops. Everything correlation goes to one. The safest is holding cash. Everybody sells everything, right? So that is like during a market panic. So what I'm trying to say here is that the reason why S&P pay you such a good return over in the long run is because you are being compensated for taking the risk. Equity risk is what I'm saying here. You can buy bonds. Bonds are safer, but you are being compensated for taking the risk. And the smart thing about S&P is because it's diversified. You're only taking the risk. You've been compensated for the risk that cannot be diversified away.
Okay,
right?
so since I'm a conservative, actually I'm a very conservative person, rather investor. That's why I tend to prefer investing into property because it's something tangible and real asset. So which means S&P 500 is considered a much more conservative method of investment compared to just jumping on individual stocks, correct?
Compared to individual stock, yes, but investing S&P 500 is still risky. So basically, in terms of money management, right, I will not advise you to put money that you cannot afford to lose into S&P 500. So basically, like I said before, you're in for the long term because you want to ride at least one boom bust cycle, right? Okay, so basically you don't put any money that you need in the foreseeable future. Could be your children's education fees, or your your parents, or medical fees, all the kind of thing. Things that you cannot afford to lose, you don't put in the market. So basically that is the simple rule of thumb.
Even S&P 500.
Even S&P 500, yeah, it's risky. Like I said, during '08 financial crisis, you can go down to 50%, and because we also incorporate options, right? So the potential loss could be even higher. It could be lower, but most of the time it will be higher. Because like I tell you, the reason why you're making such nice return is because you are increasing your risk. But we want to do it in such a way, we want to do calculated risk, right? So you want to trade off risk with profit.
Yeah,
This
but
is very
say
important. Yeah.
but say if I'm super conservative, I'm not sure what is options, but we'll keep that for next time. But I could choose not to go into options, right? So just conservatively just park my money into S&P 500 for a long time or whatever.
Yeah, you can do that too. But basically, the options is for people who are more interested in learning about options trading and how you can use that to spice up your return
Yeah, sure.
over the long run. Other than that, actually, I wanted to also answer your part about the property, right? So the property market is it's only an illusion of safety, right? In terms of the reason why property is such most people, they find it like a foolproof way of investing. It's because, first of all, the property market price is opaque. So for example, you buy a property, right? You don't really know how much you can sell the property value at. It's not like in the stock market, you can see during the trading hours, you can see the stock price moving, right? Yeah, move up, move down, it's moving. But in terms of the property, you don't really know what is the price. So it gives you an illusion of safety, thinking that the market price is not moving. But if you were to see it really moving, you will be shocked, right? That actually it moves up a lot, and also the price is opaque. You have a lot of fees. It's not liquid. Basically, it's just an illusion, and this illusion is actually a good way for you in the sense that you feel safe, so you don't sell it when you think the market is dropping or whatever. And okay, just one thing. Another thing is, for most people, they borrow money to buy a property, right? Through mortgage. So mortgage is a way as a mandatory forced savings onto people. So for most people, they are better off putting money into their property, because if they don't put the money into property, they might just splurge it somewhere, right? They can spend it, they gamble it away. They can, spend it on a car or whatever, luxury bags or whatever. So that you're forced to actually save and put into your property is a good way for you to save money. And because property price in general will tend not to go down, it will go up, maybe not a lot, but it will still go up. It will probably beat inflation. So in a sense, you still, and because you're leveraged, right, because of mortgage, so basically it's a more decent return for most people. But if you have that discipline, you can actually do that similarly for the S&P 500 as well. Because S&P 500, you're not actually borrowing money to buy, so you don't have the leverage aspect to it, which means that you might not get it's not an apple to apple comparison with a property. But the thing with property is, like when you do a mortgage, it amortize the payment, right? So basically, at the beginning, you are borrowing the money, but every month you're paying a little bit of the principal back. At the end of the mortgage, you pay the whole thing back, right, including interest and the principal. So your leverage actually decreases as your mortgage comes due. So the leverage is only at the very beginning. It will reduce as your mortgage. Yeah. So the leverage price is also not constant. Yeah, but
Okay.
anyway, yeah.
Yeah, so we have around 10 minutes left in this call, and I still have a few questions. We're talking about investing into S&P, right? Is that done by investing into SPY, or are they totally different things?
Yeah, the SPY is an ETF that you can invest in as a proxy to the S&P 500. They do not move exactly the same, but for most people, they're pretty much the same thing. And it's also liquid and cheap.
So are you saying that in the trading platform, there's a symbol for just the S&P, and there's another symbol for SPY?
You cannot buy S&P 500.
Okay, I cannot. Okay.
Oh,
Yeah.
okay.
So one way to do it is you can buy SPY ETF. There's another ETF that tracks the S&P 500 as well. And there's another way you can do it is you can do futures. For example, the E-mini S&P 500 futures. You can also use futures as well. But there is actually no way for you to buy the index. Yeah. Basically, you have financial instrument to,
So that means if I buy the SPY, it is enough, right?
Yeah.
And it's the same thing.
Pretty much it's the same thing. Yeah.
Okay, cool. So I have $20,000. So what do you suggest I should do?
Okay, so first of all, the $20,000, you're able to commit it for like long-term investing, right? You're not gonna like take it out in 6 months or a year. You're gonna put it for like, you can invest it, say, for the long term, save for your retirement, or at least not in the next 10 or 20 years. You're able to keep the money for that long, right?
Yeah, I think so.
Yeah. So okay. The way I like to put it is, you think of it like a mortgage. Like you pay for your house, right? You're not going to sell your house anytime soon, right? Because you need to live in it, right? So basically, you should view it the same way as well. So if you have 20K, that you want to invest it for the long term, and you don't need it anytime for any family emergency or anything, then I would suggest that you would just buy the S&P 500 at whatever price it is. Basically, if the market is very high, just buy when the market is very high. If the market is low, buy when it's low. Just buy at any price. There is never a good price to buy because we are not market timing. Just buy at whatever price it is for the 20K. And I would think that you also want the dollar cost average, right? I mean, put in money in periodically, say, like your monthly salary, you put in a certain amount of money. Yeah, then you will also, I would advise you to do that as well.
Okay, so for the $20,000, I should just buy anytime now. Should I split it into like increments
no,
or
it's not ideal.
okay.
Yeah, it's not
Okay.
ideal to do that. Yeah. Okay.
Okay.
So for dollar cost averaging, okay, there is some misunderstanding about dollar cost averaging. So some people they think that dollar cost averaging means that, okay, say I have a $20,000, right? So maybe
Yeah.
I put $5,000 this month, next $5,000 next month, then I write out the market, right?
Yeah.
Yeah, this is also dollar cost averaging, but this form of dollar cost averaging is proven to be not a optimal way of investing.
Just
You're
a quick
better off
question, if I can
paying
interrupt.
buying it now.
Yeah, what
But
is dollar? Yeah, sorry, what is dollar cost averaging?
Okay, so dollar cost averaging just means that you buy at different time, probably, periodically you buy at a month, you put in this amount at a market at whatever price at the market at that time. And if the market is higher, you buy less, market lower, you buy more. So in terms of you average out. So you will not be like because some people might feel that, oh, the market is so high. If I buy all now, I might lose out when the market drops, right? So I might be better off, spreading it out and average it. So that's dollar cost averaging. So dollar cost averaging, in what I described, that is also called dollar cost averaging, but that is not advisable.
Okay,
If you have a
so
lump sum of money,
yeah.
just put everything in the market. Okay.
Mm.
But the dollar cost averaging that we are advocating for our JasonInvesting is that if you have salary that you receive every month and you want to put in the market, then that is the dollar cost averaging that we are advocating because you have no choice, right? You're not going to go and tell your employer, can you give me prepay me a year of your salary so I can put it in the market? I mean, if the employer is willing to do that, probably, and if you don't mind working for at least a year in the company, lock yourself, and then I would advise you to do that. Put the money, one whole year salary, put it in the market right at the beginning. Yeah, that would be also. Yeah, but for most people, you don't have a choice. So dollar cost average in the market in this manner is optimal because there is no other way to do it.
Okay, so what you're saying is pretty much impossible to guess and time which day, which week, which month is the best day to buy the S&P at the lowest price, because obviously the lowest price means you can buy more S&P shares, right? So what you're saying is impossible to do that. So you use time over time, and obviously hoping that the performance will keep going up over 5 years, 10 years, or 20 years, such that it averages out whatever you have been buying in the past.
Yeah, but this one is only with your salary that you receive and then you want to put it in the market. Yeah.
Okay.
Anyway, do you guys have any options question?
Yeah, I have. I just want to follow up on that question. So so you are suggesting basically if I have $20,000, just invest it the whole amount
Lump
anytime,
sum, yeah.
a lump sum. Does this change if I have like 100K or half a mil? Like, would you still suggest me to just buy it in a lump sum?
Yeah. But then again, the same thing is this money is money that you're able to lock in for a while, and that you're able to afford to lose the money. But I mean, in terms of probability, the odds of you losing everything is extremely low. But safe rule of thumb is, that this money, even if you lose everything, you're not going to die. In the sense that you're not going to die of hunger or anything, right? Yeah, and of course, you're not like borrowing money from loan sharks or whatever to do this.
Mhm.
Yeah.
Yeah,
Yeah,
just to give,
okay.
sorry, Kenneth, like for Kenneth's amount of money that savings that he has, like just to give a perspective, what can you give a sense of what kind of returns that we can expect for investing S&P 500 over the same time as if we would park the same amount with the bank in a fixed deposit account?
Okay, so for banks, right, the reason why they can give you an interest rate, they guarantee you interest rate, is because uh, uh, first of all, the interest rate is really low, right? They can guarantee you for the period of time because there's a cost of funding for them, right? But the reason why for S&P 500 over time they give you a higher return is because of the uncertainty. You don't know the return. So I cannot give you a specific number, but based on historical data, I think it's about 8 to 12% a return a year.
Mm.
But this is only on average. Actually, this number actually doesn't really mean much if you just take a number, just one number, because you have to take like an interval, like a confidence interval, right? There's a range to that number. This is only just one number. It's quite misleading. But anyway, what we did in our first issue of our newsletter is we actually went back using historical data, right? We went back, I think I forgot exactly which year. I think maybe 2010 or something. We started from there. This is just pure dollar cost averaging. We do not use any options for this, right?
Mm.
So basically, we started off with, I think we started off with 20K or 50K. I don't
Mm.
quite remember. Then we, I think 50K, and then we put $2,000 every month, dollar cost average. And based on historical data starting from 2010, right, it takes about 14 years to reach $1 million. But a big caveat is past performance does not reflect the future performance, right? So take it with a pinch of salt. This number is just a one number that we back tested on the data. But then it's also a good number, a rough number for you to have a feel for it, right? Like 14 years, to $1 million. And ideally, if you do it with options, you probably would cut the number of years down.
Mm.
Yeah.
Kenneth,
Okay, okay, cool.
yeah.
I think we have time for one more question, and I think this question to me is um, very important and personal in the world of investment, right? So every time I read the news, I'm very scared because there's a lot of negative things going on, right? For example, the Silicon Valley Bank went bankrupt, right, last year, and then the current interest rate environment is like very high. And then currently there's this geopolitical situation that makes me feel super uneasy, right? Every time I'm tempted to make excuse for myself to just, okay, let's not even buy this, right? Let's not even start this. Or if I have stocks, I am very tempted to just sell everything and just let everything be over first, right? How should I overcome my own fear in this? Like, what's your opinion?
So basically, like I said, right, if your money that you're able to lose, say if you buy now and it drops 50% right from the very beginning,
Yes.
right? Are you able to accept that? If you're able to accept that, then you don't have anything to worry about. But of course, if I say this, most people will say, "Oh, you know what? I'm not going to
Yeah.
accept it," right?
Mm.
Yeah. But the thing is, you have to know that eventually the market will recover.
Yeah,
Over time, it will recover.
but the loss is only if I sell it, right? But I could wait out the whole financial disaster
Yeah.
if I'm patient
So
enough and wait for it to recover, and I don't need that money for anything else.
yeah, but a lot of people they overestimate their ability to stomach the kind of risk, right?
Which
You know,
which
I
which
think
yeah, which means maybe I stop contributing to my monthly inputs maybe, and just let whatever that's left, I just wait out the whole period.
Okay, let me put it in another way. For S&P 500, most people don't have to worry about it. You still need to think about the risk. You need to accept the risk. But a lot of people invest in S&P 500. If these people, they are okay with it, probably you are okay with it. As long as you do not buy individual stocks. Because the thing with individual stocks is any company, no matter how good the company is, might go down to zero. As in, they will literally go down to zero. The company might appear very good, right? But there could be some financial fraud, accounting fraud, they're cooking the books or whatever, you don't know. So basically, they're lying to the investors. People think that, the company is doing well, but actually it's not. It can potentially go down to zero. Any company can go down to zero, right? But for S&P 500, okay, you think about what are the possibility of S&P 500 going down to zero. So basically, all 500 companies go
All
down to
500
zero,
of them.
right? Yeah. So what kind of scenario would occur? Probably meteorite landed on Earth, and then the whole Earth is exterminated, right? Yeah. So basically, that will be zero, and we will all die. And the thing is, you have to know that for at least, especially for the US economy, right? The US market, US is, the companies are very innovative, and as you see right now, all the AI craze and everything, like the US. However, you think about the US as a country, right? But in terms of the companies, they are very innovative, and they come up with a lot of companies that are of a very high quality. So basically, you are better off betting on them than most of other shady investment, or even like Bitcoin, stuff like that. Cryptos that basically it's just purely speculative, right? And most of the time, I mean, you're not using Bitcoin to buy your purchases. It's not used for any really very material real thing. But for S&P companies, they are actually companies that they run the world, they change the world, make the world more productive, and produces all the goods and services and everything. So yeah, so you're better off betting on that for the most people. Yeah.
Okay, cool. Okay, so that's the end of our Jason Investing episode 1. So thank you very much for joining this, Jason and Andre, for sharing your expertise and helping us better understanding long-term investing. To our listeners, we hope you found this episode very valuable, and don't forget to visit and subscribe to JasonInvesting.com, and we'll see you next time.
Thank
All
you.
right. Thanks, everyone.
Okay.